Kim says, I'm interested in hearing about the benefits associated risk with the different investment levels. We've covered that off largely, but just to recap on that, Kim, the different risk levels are best probably explained by looking at the investment option PDS. So I'm just trying to get down to the section where it explains that. Got a bit of a lag here. Sorry about that. So 5 options. Ethical cash is pretty easy to explain. So here are the first 3 investment options. We've talked about ethical high growth. So 100%. This is the investment guide. This is available on the Christian Super website. So just go to publications and guide investment booklet. The high growth option. 100% in growth, 100% in risky assets. You would expect negative returns. 6 years out of 20 would be negative returns. So you've got to be prepared to see volatility, ups and downs in the fund. The idea is that you would receive at least 4% above inflation by investing in this particular option. There's an investment management fee of 0.8%. The asset allocation is 40% in Australian shares, 44% international shares, growth alternatives 10% and 6% in property. So all risky assets. The 5-year annual return to 30th of June 2014 was nearly 11%. But you can see here, there was a significant negative year in 2012. But what it doesn't show is that there were, in this particular, because it's only looking at the last 5 years, there was in 2008-9, there was like a negative, I think it was 13 or so, 13% negative. So you've got to be prepared if you invest in this particular fund for a long term. You also got to be prepared for some negative years. And then also, you can also get some great returns. So in 2013, it was nearly 24%. 2014, 16%. So high risk, high long-term return. Dropping down a notch, so having 74% in the My Ethical Super, this is the otherwise called the growth option. You need at least 7 years to be investing in this particular fund. 5 years in 20 years would be negative returns. Put a few defensive assets in here, so defensive alternatives and fixed interest, to reduce the volatility and reduce the risk, and therefore the return reduces as well. Ethical balanced option, it's 50-50 defensive and growth type options. You need at least 5 years to be invested in this option, and there's more defensive investments in this particular investment option, which means that the return in positive years, over the last 5 years, we've generally been more positive returns. Therefore, the return drops a bit as well. And then the last 2 options are the ethical stable, where you'd need at least 3 years to be leaving them to run, and you'd only have 3 in 20 years that might be negative, and highly improbable to get negative years in the ethical cash option. They're a bit more detail on those investment options. You can have a combination of them. If you're in pension phase, often it's good to have a portion in cash and the rest invested in one of the other options. I hope that explains a little bit more detail on investment options.